Welcome to Sophisticated Saving. Are you tired of seeing a significant portion of your hard-earned money vanish due to taxes? Today, we're diving into powerful, legal strategies that can help you keep more of your money. These methods are not just for the wealthy. Anyone can use them to reduce their tax bill. Let's jump right in. Before we explore the strategies, it's crucial to understand how the tax system works. Many people believe that earning more money means paying significantly higher taxes. But that's not entirely accurate. The US uses a progressive tax system with marginal tax brackets. This means you pay different tax rates on different portions of your income. Imagine your income as a series of buckets. The first bucket is filled at a lower tax rate, and once it's full, you move to the next bucket, which has a higher tax rate. For example, if your taxable income is $60,000 in 2023, you fall into the 22% tax bracket. However, this doesn't mean you pay 22% on the entire $60,000. The first portion of your income is taxed at a lower rate, and only the amount that falls into the 22% bracket is taxed at that rate. One of the best ways to reduce taxable income is through retirement plans. A 401k plan allows you to contribute pre-tax money, reducing your taxable income. In 2024, you can contribute up to $23,000. Some employers even match your contributions, giving you free money towards your retirement. However, these funds are usually inaccessible until you retire, with some exceptions for major life events. If you don't have access to a 401k through your employer, don't worry. There are other options like the traditional IRA, where you can contribute up to $7,000 or $8,000 if you're over 50 and reduce your taxable income by that amount. Another excellent tax-advantaged account is the Health Savings Account, HSA. This account allows you to set aside pre-tax dollars for medical expenses. In 2024, you can contribute up to $4,150. The money in your HSA can be used for current and future medical expenses, and it rolls over year to year, accumulating tax-free. For those with a side hustle or small business, the Solo 401k is a powerful tool. You can contribute up to $23,000 to your 401k and an additional $69,000 to your Solo 401k, drastically reducing your taxable income. This is perfect for freelancers, gig workers, and small business owners who want to maximize their retirement savings while minimizing taxes. If you have a side hustle or own a business, many of your expenses can be deducted from your taxable income. This includes a portion of your home if you work from home, utility bills, business meals, and even educational courses. For example, if you have a 300 square foot home office, you can deduct $5 per square foot, reducing your taxable income by $1,500. Investing is another area where you can save on taxes. When you sell investments like stocks, the profits are known as capital gains and are taxed. However, the tax rate depends on how long you hold the investment. Short-term capital gains for investments held less than a year are taxed about your regular income tax rate. Long-term capital gains for investments held over a year are taxed at a lower rate. If your taxable income is less than $40,000, you can pay 0% on long-term capital gains. For incomes between $40,000 and $445,000, the tax rate is 15%, and for incomes above that, it's 20%. By holding your investments for more than a year, you can significantly reduce the taxes you pay on your gains. If you're finding these tips helpful and want more strategies to optimize your finances, be sure to subscribe to Sophisticated Saving. Hit the notification bell so you don't miss any of our future videos on making the most of your money. One of the reasons Warren Buffett pays a lower tax rate than his secretary is that much of his income comes from dividends and long-term capital gains, which are taxed at lower rates. By investing in dividend-paying stocks, you can receive a steady income stream that is taxed more favorably than ordinary income. A more advanced strategy used by the wealthy is the securities-backed line of credit. This allows you to borrow against your stock portfolio at a low interest rate without selling your stocks. You get access to cash without triggering a taxable event. Imagine you have $200,000 in stocks and need $100,000. Instead of selling, you can take an SB lock at, say, a 3% interest rate. Your stocks continue to grow, potentially earning an average of 10% annually. This means you can pay off the loan with your investment gains, effectively using borrowed money to make more money. Real estate is another avenue for tax savings. When you invest in real estate, you can deduct expenses like mortgage interest, property taxes, and maintenance costs. Additionally, you can depreciate the value of the property over time, which reduces your taxable income even further. This depreciation can significantly lower your tax bill while your property appreciates in value. Contrary to popular belief, debt isn't always bad. When used correctly, it can be a powerful tool for building wealth. The key is to borrow money at a lower interest rate than the return on your investments. For instance, if you borrow money at a 3% interest rate and invest it in an asset that returns 10%, you're effectively making a 7% profit on borrowed money. Giving to charity is not only good for the community, but also beneficial for your taxes. Donations to qualified charitable organizations are tax deductible. This means you can reduce your taxable income by the amount you donate, up to certain limits. Consider donating appreciated stocks instead of cash. This way, you can avoid capital gains taxes on the appreciation and still get a charitable deduction. Tax loss harvesting is another strategy that investors use to reduce their tax liability. This involves selling investments at a loss to offset gains elsewhere in your portfolio. By doing this, you can lower your taxable income and reduce the amount of taxes you owe. It's essential to be mindful of the wash sale rule, which prohibits you from repurchasing the same or substantially identical security within 30 days of the sale. Tax credits are even more valuable than deductions because they directly reduce your tax bill. Look for credits like the Earned Income Tax Credit, the Child Tax Credit, and education credits. These can significantly lower the amount of taxes you owe or even increase your refund. Now that you're armed with these strategies, you're ready to take control of your tax situation and keep more of your hard-earned money. If you found this video helpful, please give it a thumbs up and share it with others who might benefit. Don't forget to subscribe to Sophisticated Saving for more tips on maximizing your finances. Thanks for watching and see you in the next video.